In the last recording we finished off at this slide and we were returning back to the full model after looking at the S minus I and NX curves individually. Now the interpretation that I want to emphasize, the interpretation of this model that I want to emphasize in this particular recording is one of a demand and supply curve and model. So what we have here is S minus I being 50 billion. Now we've already figured out that that $50 billion will need to flow overseas, and it will flow overseas to enter bond, share and real estate markets of other countries. But as that money moves overseas, it needs to be converted from from local currency into foreign currency in the foreign exchange market. So as that $50 billion of excess savings, and I'm looking at the S minus I line now, ignore the NX line for now, as that $50 billion of excess savings from the S minus I line flows overseas, it will create a $50 billion supply of this country's currency in the Forex market. Now that's a very simplistic interpretation of how it actually works, but it's adequate for what we want to achieve at the moment. So another way of thinking about this is that the S minus I line is actually a supply curve of this country's currency in the foreign exchange market. At the same time, we have, now let's ignore the S minus I line and just focus on the level of NX. Well, when I say just focus on the level of NX, I mean the value of NX at equilibrium. And the value of NX at equilibrium is 50 billion. That means that this country is exporting more, $50 billion more than it is importing. Now, you should realize by now that exports from a country generates a demand for that country's currency. Imports into that country creates a supply of that country's currency. So exports generates a demand for this country's currency, imports generates a supply of this country's currency in foreign exchange markets. So in a way, the NX curve can be thought of as a net demand curve. And in this case, we've got exports exceeding imports by $50 billion. So we could have been in a situation where exports are, say, 80 billion and imports are, say, 30 billion. That 80 billion would have created an $80 billion demand for this country's currency. The $30 billion worth of imports would have created a $30 billion supply of this country's currency. So the net demand would be 50 billion. And so the same sort of logic can be used as we move along this curve. We're always looking, or we can always interpret this NX curve as a net demand curve for this country's currency. So what we've got here is a supply and a demand curve, and it is then producing an equilibrium price, and the equilibrium price is the exchange rate. So what we're talking about is the demand and supply of this country's currency in the foreign exchange market in this model, and the price of your currency in the foreign exchange market is its exchange rate, the rate at which it can be converted to another currency. Or in other words, the exchange rate shows how many units of foreign currency are required to buy 1 unit of your country's currency. So the exchange rate is effectively a price, or the price, of your country's currency expressed in a foreign currency, or foreign currencies plural. So this is a demand-supply model effectively, although it's a little bit of a it's a little bit of a loose interpretation. It's not your traditional demand-supply analysis, but it has the elements of demand and supply analysis to it. Okay, the next one. You need to be able to link this to the balance of payments. Now I've already been through this previously. And I've put some numbers on these figures just to help you understand a little bit more. At this equilibrium point, where supply, the vertical line, equals demand, the horizontal line, sorry, not the horizontal line, the downward sloping line, this country has a current account surplus of 50 billion and a capital financial account deficit of 50 billion. So in that sense, the balance of payments, all of the entries in the balance of payments sum to 1. Another interpretation of what is happening at this equilibrium point is that $50 billion worth of excess savings are flowing out of this country. However, $50 billion of trade revenue in net terms is flowing back in. A current account surplus means that of 50 billion means that $50 billion in net terms is flowing back in through trade. So once again, inflows equal outflows. Now, what I've been doing here in this diagram is calling I've been calling the level of net exports in this diagram 50 billion, and then I've been calling that 50 billion up here under point number 1 a current account surplus of 50 billion. So that kind of indicates, almost incorrectly, that net exports, or the net export balance in this model of 50 billion, equals the current account balance. That's not quite the case, which is what I've got here. So in the previous slide we assumed net exports were 50 billion, and then that this country has a current account surplus of 50 billion. That's not quite correct. If you have a look at the current account, in this table there are 3 main subheadings under the current account heading: goods and services, primary income, and secondary income. Below that we get into the capital financial account, which is something different. Now in this model, NX are net exports, and in the balance of payments table that is goods and services. So what I'm doing in this simplified model, by calling net exports 50 billion and then saying that the current account balance is also 50 billion, I'm basically assuming that under the current account the primary income balance is 0 and the secondary income balance is 0, and they remain at 0 throughout our analysis. So I'm really just saying that in this model, in this simplified model, I'm really saying that the only part of the current account, there's only one part of the current account, and that is goods and services, which is net exports. Okay, now that's an unrealistic simplification, but trying to think about primary income and also secondary income in this model is just too complex at this stage. We don't need that complication. So by assuming primary income is 0 and secondary income is 0 in the current account, I can use the terms net exports and current account balance interchangeably in this model. Okay, now this is what the model is all about. Today we've just been setting up the model and trying to understand what it's all about, but really the way you need to be able to use the model is to shift curves around. You need to be able to shift the NX curve left and right, shift the S minus I curve left and right, and then explain what happens, and most importantly the intuition behind what happens. So now, in this example, let's consider a surge in exports from this country. So for example, a mining boom. If we get a mining boom, the level of exports at each and every exchange rate increases. So that is the same as saying the net export curve shifts out to the right from NX to NX1. Now as that occurs, what's going to happen is we are quickly going to move to point C. We're quickly going to move to point C. However, let's just analyse what happens in the time between that increase in exports and the the economy returning to points or moving to point C. So we've got to sort of break it down step by step what's occurring in this model. Now let's add some hypothetical numbers as I've got up here on the top right in the text. At point A, we will assume that the level of exports is 200 billion and the level of imports is 150 billion. So that gives us net exports of $50 billion. That's our starting point at point A. Now we assume a mining boom hits, or some sort of boom in exports, and so exports increase to 210 billion. Now I'm just making these numbers up, these original numbers up, and so exports have increased to 210 billion. And so what I've done is on the horizontal axis I have shifted the NX curve, or measured on the horizontal axis, I've shifted the NX curve to the right by $10 billion. So as we kind of move from A to B, or as exports, net exports move from A to B, we have this initial improvement in the trade balance of $10 billion. So the trade balance goes up by 60. Now this is in the short period of time before the exchange rate has a chance to adjust upwards. Now the exchange rate will adjust upwards very, very quickly. So it's almost like we're kind of we'll never get to point B. But just imagine that there is this brief moment in time before the exchange rate goes up that exports increase and we get this gap opening up between A and B. Now this gap opening up between A and B, that actually represents, I'll come back here, that actually represents an excess demand for this country's currency at the old exchange rate of 0.7. So it's as if supply of this country's currency is still at 50 billion, but now total demand for it has increased to 60 billion. So A to B is excess demand. And we know if there's excess demand, the price or the exchange rate is going to start rising. And that's what I've got at the top of this paragraph here, the text. The horizontal gap between A and B is excess demand for this country's currency. Now, that excess demand will cause the exchange rate to begin rising until we get to the new equilibrium at point C. What's going to happen in reality is the economy is going to move from A to C very quickly. So it's not going to move from A to B then C. It's just that we, in economics, we like to sort of break down these complex movements into steps and explain each step so that it's very clear what's going on. In reality, what's going to happen is net exports will go up, the exchange rate will begin rising almost instantly, and so in reality the economy will move from A sort of up to C very quickly. But what we're going to do, just for the purposes of explaining what's going on, is start at A, move to point B, and stay there for a little while. And then we're going to go from point B to point C. That's the only way we can fully understand the forces that are acting on this model following an increase in net exports. So at point A, and I'm looking at the text now, at point A we've got exports of 200 billion, imports of 150 billion. We have a current account surplus of 50 billion. But then at point B, the current account surplus increases to 60 billion. But now the problem is that gap between A and B, that's excess demand for this country's currency. And the excess demand has been caused by the surge in the demand for this country's exports. Now, as that excess demand opens up, very quickly the exchange rate will begin to rise, and it will keep rising until we hit 0.9, an exchange rate of 0.9. But to get full value out of this model, we need to understand what's actually happening as we move from point B to point C. Well, as we move from point B to point C, the appreciation of the exchange rate up to 0.9 is actually reducing exports in other industries. probably not, if this is a mining boom, that appreciation of the exchange rate probably won't reduce exports from the mining industry that much, but it will be other industries that export that will be harmed by this appreciation. At the same time, as the exchange rate appreciates up to 0.9 and we move from B to C, imports are going to go up as well, because with a higher exchange rate, the domestic currency prices of imports are cheaper, so import demand will increase. So what happens? We go from A to C, and the country's current account balance, or its net exports, hasn't changed. What I've got here is sort of highlighted at point A, at point B, and at point C in the text. If you compare the at point A values with the at point C values, you will see that exports have gone up by 6 billion. It's just that imports have gone up by 6 billion as well. So the net effect is that net trade hasn't changed. So the current account balance hasn't changed as a result of this. However, exports have increased, and the higher level of exports of 6 billion have actually allowed us to import more of 6 billion as well, or increase our imports by 6 billion as well. So there has been benefits associated with this increase in net exports. Net exports initially went up by 10 because of, say, the mining boom, but then they dropped from 210 down to 206 as a result of the appreciation of the exchange rate. Now, if we just focus on exports of 200 going up to 210, then dropping to 206 billion, I've just made those numbers up just to illustrate. At the same time, imports stayed the same initially, but they increased when the exchange rate went up. So we have had an overall increase in the level of trade. Exports have gone up in moving from A to C by 6 billion. Imports have gone up. It's just that the current account value hasn't changed. And that's really what I was emphasizing here, focusing on the net result. In moving from A to C, imports and exports have gone up by the same amount, so the current account balance has not improved. So then I've asked the question here, how could this country's current account balance be improved? Now what I'm assuming here is that we all agree that if the current account balance goes from, say, 50 billion to 55 billion, that's an improvement. That's just an assumption that I'm making. Okay, so what I'm really doing there is I'm ignoring this whole question of whether current account deficits are good or bad, or whether current account surpluses are good or bad. We already know that if a country's current account surplus increases, it could be for good reasons, it could actually be for bad reasons. We've been through that. So what I'm doing in calling the increase, or an increase in the balance, a country's current account balance from 50 billion to 55 billion, in calling that an improvement, I'm really assuming that the original current account surplus was a result of good economic or macroeconomic fundamentals, rather than something like a currency crisis. So let's answer this question: how could this country's current account balance be improved? And we've got the same country now. We start off at point A with a current account surplus of 50 billion. We then move to B. Then we move to a new C. And what I've done in moving to a new C, actually I've left the old 0.9 value there, maybe cross that one out, and at the new point C, maybe label that 0.80, something like that. It's just a minor typo. And so what I've done in this diagram is I've assumed that this increase in exports also increases income, and that increase in income increases savings. And so I've increased savings, the savings variable, from S to S1. Now, because I haven't put a new subscript on the investment variable, so the investment variable just has the same value. So really I'm assuming that this increase in net exports of 10 billion has led to an increase in income levels of some unknown amount, but then that has increased savings by 5 billion. So the only way the surge in exports can actually improve the current account balance is if the S minus I line shifts to the right as well. And I've illustrated that for you. So from A to C, we move from A to C as exports increase, but at the same time savings increase. It could be, however, and I've got this in brackets, the case that this surge in exports actually creates so much additional income and employment that people get so confident that their savings actually fall. And then we could have the case where the S minus I line actually shifts to the left, in which case a surge in exports would actually lead to a worsening of the current account balance, not an improvement in it. So hopefully from this you're slowly getting the sense that the value of a country's current account balance is determined to a large extent by its savings minus investment performance. And to the extent that the slopes of these lines are realistic, it's hard to ignore the result of, say, this diagram. The logic is sound. Even though it's a simple model, the macroeconomic logic contained in this model is very sound. And in that sense, that's why I think this model is a good one, because it does lead to conclusions that are very realistic. In this diagram, if you get an increase in net exports, which leads to perhaps an increase in income and an increase in employment and GDP growth and all those type of benefits, if you get all of that but you don't have an increase in savings, then even though those benefits will exist, the current account balance won't actually improve. Okay, what I will do is end this particular presentation there, and I will record another presentation which starts at this slide.